Distinguished scholars, ladies and gentlemen, my name is Jackson Malgotra, Senior Lecturer at the University of Manchester. It is an honor to present this paper entitled Embracing China from Market Fundamentalism to Socialized Mercantilist Markets, Enter the Dragon, at the 2010 Third Annual Global Studies Conference hosted by Pusan National University, Busan, South Korea. Two dominant forms of capitalism are most evidenced in national market regimes, with the notable exception of China: Anglo-American capitalism and social market capitalism. In Anglo-American capitalism, markets are open, with state effort aimed at deregulation of markets, with economic interactions competitive and adversarial. In social market capitalism prevalent in continental Europe, markets are open, but economic transactions are collaborative and relational, underpinned by government regulatory frameworks. The Chinese model differs in that while it is informed by social market capitalism, it is pegged on a neo-mercantilist model, that is, a semi-closed market with a managed central economy, which has in place legal and policy regulatory frameworks that subtly control capital movement and currency decisions. The world currently finds itself in interesting times as states around the world increasingly struggle to shake off the hangover of the global financial meltdown that commenced in 2007 and rumbled on. It seemed like it would never get to the point where major economic powers that champion the virtues and efficiency of unbridled and unfettered markets would find themselves, in different measures, pouring in billions of dollars to show up the very entities they held up as examples of the miracles of the unfettered marketplace. Who would have imagined that banks in Britain would end up partly nationalized, or that the American government would end up underwriting financial institutions from banks to insurance companies with billions of dollars? This is not to suggest that these are the only two countries that had to put in place stimulus packages. Everybody did in varying measures. The issue was that it was the high priests who preached the healthy qualities of drinking wine suddenly discovering the joys of water. The pun is intended. Prior to the financial meltdown, proponents of the Anglo-American model rejected any view that did not support radical individualism and libertarian views that place private property ahead of all other values. Simply put, they believed that there is no such thing as society. Rather, the claim was that society is an aggregation of individuals with individual preferences. The result is that Anglo-American style economic globalization ushered in a new hegemonic era of global capitalist prosperity that sought to transcend the capital business cycle and obviate the need for state regulatory, fiscal, and monetary policy. However, in this model, the mobility of global finance capital and its ability to flee national economies whose policies do not accord with its model of development denies domestic policymakers the ability to protect their populations from the cyclical nature of capitalist market economies. In its engagement with neo-liberalism and free market orthodoxy, China has consistently rejected some of the Washington Consensus's more problematic assumptions. In particular, the view of trade and markets as strictly a one-sided economic benefit tool and unfettered markets. China's circular economy model demonstrates that market liberalization does not impair a country's ability to attract capital, and that responsible government action and regulations can create a vibrant economy which engages the government in the distribution of the benefits and the burdens of wealth generation. China, which resists topple capitalism, seems in the current climate to be the only major economy to enjoy growth and to sub-optimize the extant dominant market fundamentalist model that consciously thrived on creative destruction, survival for the fittest, and ever-increasing reallocation of resources to big profit entities deemed to be the most efficient market players. The IMF's own studies show that countries which reject unfettered financial market liberalization do reap dividends of an integrated global trade and financial marketplace. It is sensible enough then that not all states believe that transnational corporations should abolish domestic traditions that limit foreign access within retail, financial, and insurance markets. Equally, there is no global consensus that financial capital invested in money and stock markets should be able to to flee national borders at a nanosecond's notice without the ability for regulation. To conclude, the reality remains that market liberalization entails a significant risk of amplifying global instability, and historically, free capital flows, unlike flows in goods and services, are underpinned by panics and manias. In essence, whenever history repeats itself, the price goes up, as we are discovering in the current flattened financial climate around the globe. The international community now finds itself in the need of an orderly international regulation of finance capital to shield national governments from speculative capital's veto power over domestic policy. The reality is that capital and financial markets cannot avoid speculative crises and deflation of the real economy absent effective state regulation. The global financial meltdown is testament to the counterside of deregulated capitalism. It effectively exposed the underbelly of Anglo-American casino capitalism, which essentially prioritizes short-term profit and stock market performance and makes taxpayers servants of the free market. Thank you for your time.